Welcome to the Live Big podcast, where real estate expert Nick Paynes shows you that everyone can build wealth through real estate investing. Nick and his featured guests will give you the tools, resources, and expert information you need to leverage real estate into a wealth-building strategy, so you can stop worrying about your 9-to-5 and start to live big. Here's Nick with today's episode.
Welcome back, everybody, to the Live Big podcast. We are going to talk about some more real estate today. Let's talk about the current market. I'm getting a lot of questions about where things are at in the current market. And we've got a lot of fear and there's a lot of complexity. And I think it's time to address some of the concerns that people are having and maybe talk about some of the hope that's on the horizon. So a couple of things. Let's talk about where things are at currently. Right now is at least, and we're talking about the local market here in the Denver metro area, but right now, as of August 15th, when I'm recording this podcast, homes under $600,000, single-family homes under $600,000, for the first time in quite some time, many years, have surpassed 1 month of inventory. And so it's kind of a crazy figure to think about, because generally speaking, when we're talking about inventory, we think of a 4-month inventory as a balanced market. This would be where, buyers and sellers have this, it neither has an advantage. And so 4 months of inventory is where that balance is. And we've been in a seller's market for quite some time. And right now it feels almost like we're in a buyer's market, but it's because of the relativity of what the market feels like now versus what it felt like back in 2021, 2022. And so right now we have about a little over a month's worth of inventory in single family homes, 600,000 and below. We're also feeling a little bit of relief in our move-up market. So homes for between 1 million and 1.5 million, it's a great time to buy in the 1 million to $1.5 million range, just because the move-up market is very strong right now. We are averaging between 6 and 7 showings per month on listings, which is a far cry from the 50 to 60 showings in the opening weekends that we were seeing back in 2021 and early parts of 2022. So things have changed a little bit over the last couple of years, but we are still in a seller's market. And a big part of that is due just to the overall lack of inventory that we have in general. And so some of the things that we're looking at and some of the things that are causing the current market that we're in are the rate pressure that we have, the low inventory that we have, and just the fact that people aren't moving essentially unless they have to. Most people are unwilling to exchange a 3.5% mortgage or a 3% mortgage for a 7% mortgage, which is kind of where we're sitting at right now. Mortgage rates are sitting in the 7.25% kind of window. And a lot of times, a lot of people that refinanced or purchased back in 2020, 21, 22, have, rates even in the 2s. And so it's kind of a hard pill to swallow, exchanging your current rate of a 3% into a 7% unless you have to move. So a couple of things, and here's what that creates from an outlook standpoint. So there are some things economically speaking that we need to understand to try to predict or know where things are going to be at. What we have been encouraging people to do over the last couple of months is, as buyers especially, is to get out and take advantage of the market that has slowed a little bit due to the increased interest rates. Those increased interest rates have pushed a lot of buyers out of the market, or at least pushed them out of the price range that they want to be in. And so we've encouraged our buyers to get off the fence and do one of a couple of things. One, take advantage of the fact that there might be listings sitting on the market for a little bit longer now, that we can negotiate in concessions, get closing costs taken care of, potentially get buy downs on the mortgage rate and temporary buy downs on the mortgage rate. And the current market is allowing us to do that because, again, people have been so used to the market that we've been in for the last couple of years, where they put up their place on the market, and within the first weekend, they're under contract with multiple offers, maybe multiple offers over list price, that now if they don't sell on the first weekend, they start freaking out, and they're willing to accept a price that's less than their list price. We're starting to be more in a market where people need to understand that it's okay to be on the market for 30 days. It's okay to be on the market for 45 days. And sometimes you just need to wait for that right buyer. So we're encouraging our buyers to get off the fence and do a couple of things. One, we're doing our best that we can to try to get these buyers temporary rate buydowns. We call them 2-1 or 3-2-1 buydowns. And what those buydowns do is a 2-1 buydown, for example, gives a 2% rate reduction in the first year and a 1% rate reduction in the second year. And generally speaking, those buydowns are paid for by the seller. And all it is essentially prepaid interest. So they're prepaying a certain amount of interest to lower your monthly payment for the first year by X amount of dollars and lower your interest payment or your total monthly payment in the second year by Y amount of dollars. And so what this does is it creates a little bit more affordability in those first couple of years, giving you an opportunity for a couple of things. One, maybe to advance your position in life and maybe advance your position in your career where you're making a little bit more money. And then that total monthly payment that comes in year 3, for example, becomes a little bit more palatable. The other thing is that we feel very strongly that we will see some rate reductions and some rate rebounds on the horizon in 2024 or in 2025. More signs point to 2024 than 2025, but in general, a 2-1 buydown gives you the opportunity to get through all of the rest of 2023, all of 2024, and part of 2025. Now, if you can get a big enough concession to do a 3-2-1 buydown, you can do the same thing. And in this case, it's a 3% reduction in the first year, 2% reduction in the second year, and a 1% reduction in the third year. So these are really powerful opportunities, and we're talking significant amount of savings in a 3-2-1 buydown on a median-sized loan somewhere in the $450,000 to $550,000 loan range. On a 3-2-1 buydown, you're probably talking somewhere in the neighborhood of $900 per month savings in the first year, $500 per month, $600 per month in the second year, and $300 per month in the third year. So it's a significant amount of savings. And what it is, instead of doing a full term, full 30-year rate buydown where you may save $30 to $50 per month for the entirety of the loan, you're basically front-loading those savings. The other nice thing is with a rate term buydown where you're buying down, again, those all 30 years, if you refi out of that loan, you lose that rate and you lose that money that you paid into that. With a 3-2-1 or a 2-1 buydown, all it is prepaid interest, and it's generally held in escrow. So what happens is if you refi out of it, you get to use that money. You get that money back. That money can then be used towards closing costs or a permanent buydown of your new refinanced loan, or it can be used towards closing costs for that new loan. And I may have already said that. So it can also be used towards a principal paydown of that particular loan as well. So it's not like a use it or lose it type mentality with a temporary buydown as well. So anyway, it's a really powerful product that makes the monthly payments a little bit more palatable for your first couple of years. So the goal here is to get into one of those loans and then get yourself in a position next year for a refi. Okay, so let's talk a little bit about why we feel very strongly about the refi opportunity that we should see in 2024 or 2025. First of all, kind of full disclosure, this is there's a lot of numbers here involved, and there's a lot of economics involved here. And I'd recommend, if you're interested in this type of stuff, there are tons of resources out there from a lot of the top economists through the National Association of Realtors, through big real estate companies like through NAR, and a lot of the big banks as well. So Bank of America, Wells Fargo, Chase, all put out big reports on with their economists and what they see happening with the economy, with interest rates, and with housing prices. So a couple of things to look at. First of all, the mortgage, historically speaking, mortgage rates have, for whatever reason, we would think it would make sense for a 30-year mortgage rate to kind of follow along with the 30-year Treasury note offered by the government. However, it's more tied to the 10-year Treasury. And so if you look at a graph of with the 10-year treasury, the interest rate on a 10-year treasury has done over the last like 20 to 30 years, and compare that with the mortgage rates, they're almost, they run essentially parallel to each other at all times. So one moves and the other one moves with it. So if one ticks up 25 basis points, so does the other one. And historically speaking, those two rates have had a spread of about 2%. Okay. So those rates are within 2% of each other pretty much at all times. Right now, for whatever reason, over the last year to 2 years since COVID, there's been a bigger spread between those two rates. So instead of being at 2%, they're actually about 3% right now. So if they get back to the historical norms, okay, the interest rates for mortgage need to come down about 1% to get back to that 2% spread. So right off the bat, if nothing else economically were to happen, and we were just to get back in line with the treasury yield and the spread that we have normally between the 10-year treasury and the interest rates, we'd already see a 1% reduction. So again, with interest rates being at 6.25, at 7.25 right now, that 1% rate reduction would bring us down to 6.25. So that's kind of the one of the first clues that says, hey, we're in this kind of a volatile rate market right now that is that's not normal. So if we get back to the norm, we're going to see those interest rates pull back. Okay. The second thing is that we're seeing a few things. One, we have what we call an inverted curve for our treasury. And so what happens is when we have this inverted curve for the treasury, we end up in a situation where what that means essentially that your 2-year treasury notes or your 5-year treasury notes are actually paying more interest or more valuable than your 10-year treasury notes. Now, if you think about that, that's inverted of what it should be, right? If you're going to go to the bank and give them your money for 10 years that they can use, you should get paid a higher interest rate than you do if you only give them your money for 2 years. Well, right now, that curve is inverted, okay? So it means that they're paying more money on the 2-year than they are on the 10-year. So what that essentially means is that investors are hedging their bet on saying that, hey, we know that it's going to go back to normal at some point. And the way that it's back to normal is we start to pull those interest rates back, okay? So the Fed has increased interest rates between 25 and 75 basis points, essentially, for the last year, maybe actually a little longer than that. We're in August. So since basically last May, we started seeing these increases in the Fed rate to try to curb inflation. Well, those inflation numbers have come down significantly now. And we know that based on what the Fed has come out and said, we know that September is likely going to be the last, if they even raise the Fed rate at all, will be the last rate movement that we see in a northward direction or increasing the Fed rate. If you look back historically speaking, since basically the 1950s, and you look at the federal rate, you look at mortgage rates, okay, and you see since 1950, we've gone through 10 recessionary periods, okay? And these recessionary periods, we're going to get into a little bit later in this conversation regarding what recessions look like. But over these 10 recessionary periods, one of the things that you'll see is anytime the Fed raises the rates, okay, it's very far and few between that we see a plateau at the top where the Fed raises the rates and then they just kind of sit there for a period of time. Okay, generally what happens is we see the Feds raise the rates and they generally overcorrect. Okay, so we have such a heated environment, such an inflationary market that the Feds raise the rates so high that what happens is it curbs inflation. It does its job so well that it kind of throws us into these recessionary times. And so the Feds immediately reverse course and start pulling rates back again. Okay, so if you look back again on the last 70 years, since the 1950s, and look at the Fed rate increases, you'll see they peak out and you very rarely see a plateau at the very top. The last time that we had a plateau was during the Great Recession back in 2000, right around 2007, where we had about a year period or a year and a half period where the rates kind of plateaued and sat high before they started coming off, okay? But again, that recessionary period that we had there was a very difficult recessionary time because of bad loans that were being written, basically starting in 2003, the no-doc loans, stated income loans, things like that really drove the economy into this suppressed. Well, I should say at the time we were selling houses like crazy. In fact, 2005 was the best real estate market in history. The most amount of houses sold. The real estate market was absolutely booming, but it shouldn't have been like that. The reason it was like that is because we were approving anybody for any amount of money that they wanted based on no-doc loans and stated income. That should not have happened, and that's what caused the Great Recession. So what we're in now is a little bit different. Okay, our lenders are more strict than ever. We have truth in lending laws that don't allow people to get loans, no-doc loans, or at least no-doc loans that are government backed. Okay? They're not allowing the predatory loans that existed back then. So anyway, these increases that we're seeing from the Fed, it's very unlikely that we're going to see those sit for any extended period of time. So what's going to happen is if we see one final increase here in September, it's going to kind of be that peak that we see. And then what we imagine seeing probably within 6 months after that, the Fed's going to start dropping the rates. Many economists believe that we're going to see a 2% decrease in rates in 2024. So all of a sudden that Fed rate is going to pull back 2%. And we think it's going to be done 50 basis points at a time. And so the reality is we're going to be able to pull that back hard and fast. And as that happens, we're going to see interest rates pull back into a more conservative, maybe somewhere in the 5s, maybe even in the high 4s. And what's going to happen at that point from a housing market standpoint is we're going to create another buyer's boom, because the people who missed out on the 3 and 4% interest rates and are now sitting on the sidelines because they're seeing 7, they're not going to miss out again. The second thing it's going to do is it's going to bring, we have a ton of pent up demand. Okay. So, and it's the demand of people that have not moved because they didn't have to, right? So right now, we're seeing people move that have to. Job creation, household creation, job relocation, divorce, death, things like that. Those are the people that are selling homes because they just want something bigger. It's just not happening as much right now. And so what we're going to see is that pent-up demand that's been sitting there now for over the last year and a half of people that want to move, maybe because they had that second kid or that third kid, and now they need a little bit bigger house, and their kids are sick of sharing a bedroom or whatever it may be. That pent-up demand is going to start coming to fruition as those rates come back down, and people who are unwilling to trade a 3% for a 7% now might be a lot more willing to trade a 3% for a 5%. Okay. So, and as we sell more houses because of that, or we see more homes come to the market because of that, it won't change our supply, because all we're doing is we're selling a house to buy a house. So we're putting one on the market, but we're taking one back off in order to do it. So it's not increasing or improving our inventory problems, right? And so our inventory problems ultimately are always going to be the base of the market that we're in, and the supply and demand. So as rates get better, we're going to have more demand, and we're probably going to have more supply, because those movers and that pent up demand is going to think about selling as well. However, as rates get worse, like they are now, we still have enough demand through those 4 or 5 circumstances that we talked about that cause our inventory to not be enough. And we don't have inventory because the move-up sellers and buyers are not willing to put their house on the market. So we're kind of in this catch-22 from an inventory standpoint, and our builders really just can't catch up. So, and we've talked about that before in one of our prior podcasts that I won't get into, but infrastructure problems cause builders not to be able to build as much as maybe we should be to try to catch up with demand. But right now in the United States, throughout the United States, we're at a 1.6 million home deficit. And that's a combination of both your rental properties and your purchases. I think it actually ends up being somewhere around, we're 900,000 rentals short, and we're 700,000 single family residences short. So anyway, we have this huge inventory problem that we can't really overcome. And so what's going to happen is when those rates come down, we're going to create more buyer demand, and we're going to drive prices up again. So the crystal ball, the crystal ball, so to speak, that people always ask for is, what should we do? When should we make a move? The reality is now is actually a good time. And even though the rates are scaring people away, if we can get you into a 2-1 or a 3-2-1 buy down, it'll give you the opportunity to sit on a nice low payment for the next year or two and still take advantage of a refinance opportunity that's almost certain to come. Okay. So one of the things I want to get back to is the recessionary times that we've talked about. So again, recessions are we've had 10 of them basically since the 1950s. And if you go back and you look at those recessions and you look at the duration of each of those recessions, generally speaking, recessions don't last much longer than about 18 months. Okay. So we had a really short recessionary period at the beginning of COVID. If you go look at some charts on I'm gonna mess this up, but the acronym is FRED. It's like the Federal Reserve something, but it's essentially a website that has data on everything economics, macro, microeconomics. So if you go look at their chart and you see all of the you see all of the recessionary times, you'll see the biggest recession that we had was in 2007, and the duration of that was the longest recession since we had the Great Depression in 1929. Every other recession has been pretty short, including we had a very short recession right at the beginning of COVID, which was a couple of months at most. And the recessionary period that we're quote unquote supposed to be in right now, because of the 2 consecutive negative quarters of GDP that we had back in 22, that recession hasn't really been here, right? Recession calls for job losses and decrease in cost of goods, and we haven't seen any of that. And people aren't keeping their money in or keeping their wallets in their pockets anymore. So we don't have that recessionary period. So even if the next Fed rate, for example, the next, let's say they do another 50 bips in September, even if that next Fed rate movement comes and drives us into recession, the reality is that, let's say that recessionary period starts here at the end of the year in 2024. Recessionary periods, historically speaking, don't really last longer than 18 months. And the Fed starts to reduce rates during that recessionary period in order to start bringing the economy back. And so what'll happen is, even if we're 6 months out from a true recession, okay, the Fed will start reducing rates in 2024, which means if you buy a property right now in August of 2023 with a temporary rate reduction for your first year and your second year, there's no doubt in my mind that you will have a refinance opportunity in 2024 to bring that total payment down. And again, potentially in 2025, we may see rates pull back 1.5% in 2024. And I would say, go for it, refinance the property at that point. And if rates continue to get better in late 2024 and early 2025, refinance it again. And just keep improving your position. But buy the real estate, lock up the real estate while real estate is attainable at a reasonable price. Because once those rates come back, we're going to see prices driving up in that other direction again. So anyway, the economic factors that contribute to where we are at currently is why we feel like we have a pretty good crystal ball looking into the future of what rates look like, and why we feel very confident talking to our clients about the ability to purchase a house now with a temporary rate buy down and know that they're going to get a great refi opportunity in 2024 and 2025. It's because all the signs, all the things that we look at to determine where our rates are going to be, all of those signs currently point in that direction. And historically speaking, every time we go through this cycle, we end up exactly where we're saying we're going to be, 12, 18, 24 months from now. So that is the big, I do market updates on a monthly basis, and they're usually 3 to 4 minutes. Obviously, this one's a lot more in-depth, talking about the macro microeconomics that have to do with why rates do what they do and why the real estate market does what it does. But the reality is starting next year, if rates recover, or I should say when rates recover down into those fives again, we're going to see a very healthy appreciating real estate market again. Maybe not back up in those 12s and 14% that we saw for so many years in a row, but we are going to see the 5%, the 8%, the 9% appreciation in many of the big areas throughout the United States, and continue this housing boom. And we are a long way out from any type of major pullback in the market. The last piece I want to add is the overall buying is just to briefly talk about the overall buying frenzy that's about to happen. So whether you're a real estate broker or a real estate agent in the industry, whether you're looking to buy and acquire property or buy and hold property, one of the things to understand is that the average age of a home buyer right now in the United States is 34 years old. Okay. And 2 years from now, okay, right now in the United States, I should say not 2 years from now, but right now, the largest population by age in the United States is 29 years old. Okay. And the second, third, fourth, fifth largest are all right there as well. They're 32, 31, 30, 27, 28. So over the next 10 to 15 years, we are going to have the most home buyers that we've ever had. So real estate agents, if you're having a tough year, prepare for the bounce because it's about to come. We are a couple years out. We're a year out, 2 years out from seeing a tremendous influx of buyers coming into our market. Okay. And that's going to continue to drive prices up. Investors, prepare for the bounce. Buy property now while it's attainable, while you can get a deal, date the rate, okay, rent the rate, whatever you want to call it, and refi when the opportunity comes. But the appreciation in real estate that's ahead of us over the next 5 to 7 to 10 to 15 years, I'm super excited about it. Anybody that's out there that holds a couple $1 million worth of real estate right now, just wait and see. You'll be thinking about retirement a lot earlier than you had previously because the appreciation, take those couple $1 million and start appreciating them by 5-8% per year. And all of a sudden, you're going to see a pretty tremendous number in the next decade. So prepare yourself for this. Now's a great time to do it. Reach out to me, reach out to our team. Would love the opportunity to figure out, how we can put you in a position to take advantage of the next few years to come. So hope this was helpful. Hope this was informational for you. You can take it, implement it in your life, however you see fit. But I think the best way to do it is go invest in some real estate and live big over the next 10 years.
Thanks for joining us for this episode of the Live Big podcast. For even more real estate and investment resources, go to blackyetigroup.com/resources and download Nick's complete guide to running your own rental properties. Tune back in next week for another episode, and until then, live big.
Live Big does not provide investment, legal, or tax advice, and nothing herein should be construed as being financial, legal, tax, or other advice. Live Big does not represent that any securities or services discussed are suitable for any investor. No investment or other decision should be made solely based on the contents or information found on the website or podcast. When making a decision about your investments, you should seek the advice of a professional financial advisor or qualified expert.